You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody. That music means it is Interview Tuesday here on the Options Insider Radio Network. Time for Options Insider Radio, the titular program that started it all way back, 14 plus years ago and morphed into this network so many of you are enjoying. I want to remind you all, if you like this show, anything else we do on the network, pretty much a dozen programs coming at you these days. Make sure you keep rating and reviewing on your platforms of choice. We've seen just an explosion of new listeners over the course of the past year. These are turbulent times, to put it mildly, out there. So give the folks out there a place to turn in these stormy seas. We will be their lighthouse. Keep rating and reviewing wherever you get this content across all the platforms. Of course, keep those questions and comments coming in too. We do love to hear from you guys out there. And let's see who we're hearing from on the old program today. Joining me on the Options Insider Radio interview program today, we have Paul ROWADY. He is the Director of Research at ALPHACUTION Research Conservatory. Paul, welcome to the Options Insider Radio program.
Mark, great to be here.
Paul, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a little bit of an overview of your background in the options and derivatives markets, as well as what it is you do day to day at ALPHACUTION.
So my personal background goes back to O'Connor and Associates, pre-Swiss Bank, pre-UBS, so early 90s. And I spent the first half of my career, 3+ decades now, in prop trading arenas, derivatives, and quantitative strategy development. So all the juicy topics that are important today essentially boil down into the impact of technology in capital markets. And that is really the tagline for ALPHACUTION, which is a research and advisory group that I founded in the early aughts in 2004 to develop some technology, and then ended up rebranding it, repolishing it, relaunching it in 2015 as a research and advisory group that I run today. And what has attracted a lot of attention is using a lot of data that's lying around, as I often write on our feed, the blog, lying around hidden in plain sight for free, which is a lot of regulatory data that's difficult to make sense of because it's not streaming. So I've taken the time to lift a lot of that data out of the documents and out of the containers that it lives in to paint some pictures and tell some stories about some of the most secretive, mysterious, mythological players in the capital markets universe. And that gets to many of the dominant players in options. And over the last few years, writing regularly, publishing a weekly blog, and developing some unprecedented case studies on some of these players, we've attracted quite a bit of attention.
Well, that certainly is what brought you to our attention here, of course, the case studies, and they're fascinating. I want to get into those in a second. By the way, you mentioned you're finding this data hidden in plain sight. I like that term. How much time do you estimate that you spend just reading regulatory circulars and on the SEC and FINRA websites, Paul?
Too much. Too much. I'm on a Friday night, Saturday night, I'm pecking around. It really is, if you know how to find it and if you know how to read it, and if, as we've done here at ALPHACUTION, we've taken the time to organize it over as many years as we can find. It's really all the data that we can find, in some cases going back, in case of some of the 13F data, which is some holdings data that goes back into the mid to late 90s. So, sometimes I can draw not so much on the option players and the prop firms. Only a few of them go back into the late 90s, but take a Fidelity, for instance. I can draw a picture of their holdings from 95. And that's pretty fascinating, that kind of a wide view, which gets to a little bit of a theme that we're exposing, which is, while everybody has their face planted up against the glass looking at market microstructure, I like to think of what we do here as market macrostructure research, looking at how the players are aligned on the field. Because I think that kind of competitive intelligence is something that a lot of folks don't think about. They think that they're swimming in this vast ocean of trading opportunity when in fact your competitors are potentially eating your lunch right next door. So I think that is a theme that, we're in a bit of a green pasture doing something that very few, if any, have ever done before.
Well, it certainly is interesting content. Like I said, the case studies are fascinating. I want to get into all those in a second, but we can't ignore the elephant in the room, Paul, which to me, the fact that it is the elephant in the room in and of itself is fascinating. This controversy over PFOF is nothing new. It is kind of the oldest of discussions in the option space. In the options world alone, it dates back well over 2 decades. And I remember back in 1999 and 2000, back on the floor of the CBOE, we were sending data to the SEC then saying that we thought payment for order flow led to bad executions. 2 decades later, that conversation is still going on. In fact, when we founded the Options Insider back in 2007, at that point, the conversation was already old, and we kind of tabled the discussion of it because it didn't seem like anything was happening. It was kind of a done deal from the SEC's perspective. It didn't seem like they were going to change their mind anytime soon. Fast forward now to 2020 and now into early 2021 with the Robinhood saga, and all of a sudden, all things PFOF and Robinhood have become sexy and top of mind again. You've been out in front of this for a little while now here, Paul, making some, shall we say, interesting comments on this front. You made this comment to the folks over there at USA Today. You said the folks at Robinhood have specifically designed a frictionless, highly gamified platform that's heavily weighted toward trading options, and they've grown so quickly and aggressively that their business model borders on the abuse of their own clients for the enrichment of themselves and their shareholders. So, Paul, I wish you would stop holding back and let us know your real opinion, sir.
Well, that's, the beauty of running my own shop is I have total creative freedom, and which doesn't, I have a frictionless environment in which to vent my spleen. So it occasionally gets me, fortunately, I don't spend a lot of time on Twitter. So I don't get into the rage machine. I don't hear what, people are saying under their breath when they read some of my stuff. But it's also strategic in the sense that as a content developer, we're all fighting for your attention, because without your attention, I can monetize nothing. So there is a little bit of strategy in terms of how you put a title on the top of a piece, the imagery you use with the piece, some of the language you use with the piece. So it can get sometimes a bit hyperbolic, but I don't think I stand by the spirit of what I said there for USA Today and the about Robinhood is the business model that borderlines on the abuse of their own clients. I think that there's an argument to be made there.
Well, you've been watching this space for a long time, as you said, not just in the microstructure perspective, but from the 10,000-foot macro structure perspective. This PFOF debate is not new. It is old. It has raged for decades, even longer, if you take it out to the equity space out there beyond the options landscape. What are your thoughts in general on this practice of payment for order flow and the impacts it has on the markets? I have a feeling I know where you fall from that quote, Paul, but what are your thoughts on this?
So you got to remember that there's a couple of catalysts that cause this debate to become far more turbocharged in the current environment than it had ever been before. The first of which is you had the growth of Robinhood, which was specifically designed to operate in a zero commission framework. And they grew to the point where they forced their key competitors, TD and E-Trade and a few others, to copy them because they saw Robinhood with this zero commission framework that underneath the hood was based on payment for order flow. That the payment for order flow going to Robinhood is replacing the commissions. So now you say, okay, you can trade for free. That gets us to frictionless. And I had been writing about and estimating Robinhood's payment for order flow since about 2018, which put me somewhat at the forefront for folks that were, when I first started estimating and writing about that piece of the Robinhood story, it got a lot of attention and it put me somewhat in this strange space of, I was following prop firms. I really didn't have a whole lot. I wasn't necessarily looking to have anything to say about the retail platform environment. But the unique aspect about ALPHACUTION is that we're not just in silos. I'm solving a massive Sudoku puzzle. So if the research and if the themes take me to a new category like retail brokers, then I go there. And so my ability to speak fluently across retail to wholesale was a unique aspect that a lot of other research providers and pundits and think tanks and thought leaders didn't really have the modeling done. So that's, a little bit of an embedded commercial. The other catalyst, so Robinhood and the change in going to zero commission framework by the likes of TD and Schwab, we're talking about October, November 2019. So we're a little over a year and a half into a major transformational event in how retail brokers operate, a business model transformation for pure retail brokers. If we look at Schwab, a lot of their business is elsewhere, so they're not as dependent. But for the likes of Robinhood, highly dependent. So that's catalyst number one. Catalyst number two is, as of 2020, the Rule 606 filing, the disclosure about payment for order flow, was upgraded to include all the dollars. And that really allowed some of us, myself included, and a few others that are following market structure issues closely. In the past, you only got the percentage of order flow sent to various destinations. But now we were getting a cleaner look at the dollars associated and the rates. And then, so as of Q1 2020, which coincided with the explosion in trading activity that occurred as a result of the pandemic lockdown, you had in just a few months a convergence of catalysts that it caused the economics of payment for order flow to move to a place that was entirely unprecedented relative to its history, as you suggest, going back 20 years. But just as of the last year or so, the last 4 quarters, because now we're into 2021, but we still, it'll still be 60 days or more before we see Q1 21 Rule 606 forms. We really have the 4 quarters of 2020 and payment for order flow and all the players that are involved and what rates were paid for what types of orders. And that is our first real, detailed view of what it means to have this mechanism existing between the retailers and the wholesalers.
It has been fascinating to watch the evolution of this because you're right. When Robinhood first came on the scene, I think everyone who'd been in the business for a while, this model was not new. People had tried the free brokerage before in the past. It usually failed. But in the past, they always had margin and other things to rely on. Those were obviously less of a player in the modern market environment. So they had to rely even more heavily on things like payment for order flow. So everyone in the business knew effectively at the end of the day, if you're not charging your customers, and if you're not getting any sort of real tangible margin revenue, then end of the day, the customer is the product. And it seemed like a lot of people on the outside really embraced this whole marketing ethos of Robinhood and for the little guy. And when the information finally came to light that actually they were doing this practice that everyone else pretty much assumed they were doing forever, it really seemed to rub a lot of people the wrong way, Paul.
Yeah, it elevates a debate, and we're going to have that debate over the foreseeable future. I'm not quite as clearly negative as some of my language might suggest about payment for order flow. I'm more concerned about, the idea of something that's frictionless. So that does address the fact that payment for order flow is compensating the retailers in lieu of what would have been commissions in the past. I think a little bit of friction takes the sting of the casino nature of markets off the table. Right now, with people still locked at home and looking for things to do and having a frictionless environment, it creates a lot of gamesmanship, no pun intended, in markets. And I don't know that we want to have that kind of gamesmanship front and center in the headlines in U.S. capital markets. I just don't think. I think it's a short-term, caffeine boost or whatever your dopamine of choice. But as a long-term thing, I don't think it's good for markets. So that's where I come down, and equally so the gamification, the euphemism that I use that Robinhood has become somewhat famous for is the confetti bomb that goes off, when you have a successful trade or you do certain things. That kind of gamification, again, gets to the casino nature of markets, which I think we want to be careful not to let run loose. And, I hate to say that out loud. I'm not looking to be the guy, as I've written, I'm not looking to be the get off my lawn guy. If you want to piss your money away, have at it. But I just think generally it's not great, to turn this thing into a casino.
Put down your business card. I'm the get off your lawn guy here in the business wall. But we could talk about Robinhood probably for the rest of the conversation here, and folks would eat it up. But there are other things cooking out there that I want to kind of pick your brain on. Starting with, for example, you referenced the explosion of options volume last year. Of course, last year, take the adjective. It doesn't really apply. Unprecedented, absurd, obscene, throw it all in, and they all fail to adequately describe the year that was 2020. But from an options perspective, it was particularly unprecedented because you had a litany of things happen that we hadn't seen before. First off, the entire industry went electronic, 100% electronic for the first time. So storied pit products like SPX and even the Eurodollars, all 100% electronic for the first time. No one thought that would happen, certainly not last year, maybe down the road, but not in 2020. And yet also at the same time, we had a majority electronic market for a good chunk of the year. We saw these record volumes going up across the board, Paul. So I'm curious, maybe I'm a bit cynical. Sounds like you are as well. So I guess we're similar minds in that respect. But when I saw this shift to a fully electronic environment, I said to myself, okay, here we go. Here comes the outages. Here come the crazy quotes and misprints and all sorts of other nonsense that really might drag the markets down. And not only did the markets survive, Paul, but they flourished in that mostly electronic environment. Were you as surprised as I was that the markets thrived during that period?
Well, I will say that, if you had asked me in February of 2020 what the year ahead looked like, I probably would have missed a lot of the convergence impact of the lockdown and people looking for ways to be entertained, and listed markets, generally speaking, becoming as popular as any Netflix show out there. That seeing it as a game or as a casino, as a way to pass time, as a way to speculate is a lot of fun. And so I would have missed the impact of the lockdown, the frictionless and highly gamified environment on volumes. I probably would have missed the extent of that. I don't know that. I think that the lockdown was a great excuse to go fully electronic because you couldn't have crowds of people on a floor anymore, even if those crowds are highly diminished from years gone by, right? So I think that's a good excuse to, fully turn that knob to 11 and go all electronic if you can't have a bunch of people able to stand together on a floor. I think the catalyst that fuels the unprecedented volumes is the retail trader that's home looking for something to do, that now has an app on their phone that's frictionless, so I can trade as much as I want. And guess what? With Tesla at $1,000 or $2,000, I can trade a Tesla option with my $500 account much more easily than I can buying the stock, even fractions of the shares of stock, which is not quite, fully launched. So it makes sense in hindsight that options become popular in that environment when you have a lot of new investors with small account values looking for ways to be active. And here you have options that are priced in such a way that you can trade them easily, and you can trade them, 1, 2, 5 lots, 10 lots, and it doesn't, you don't have your whole account sucked up in one position. I think that's really the catalyst that causes the unprecedented volumes for 2020. And even now, moving into 2021, the volumes in January and February were even bigger. So we're not done yet. We don't know quite how far this is going to go.
Yeah, you're right. I think everyone assumed 2021 would come in with a whimper, but it has roared in like a lion so far this year. But, going back to 2020 for a second here, one of the other interesting things that I said kind of brought you on our radar here at ALPHACUTION was you guys do these fascinating deep dive case studies into the weeds of the option space, in particular a lot of the market making and trading firms that are lurking behind the scenes and typically off the radar of your average trader out there, outside of these obscure debates about PFOF and when things like Citadel are trending on Twitter. We're in a weird world out there. But you did an interesting case study on the demise, the implosion of RONIN last year. Of course, they were, I should say, a storied market making firm with particular expertise, at least everyone thought, in the index and volatility space. In fact, their risk management and risk surveillance suites were so well regarded, they spun off an entire new standalone company just to sell them to other firms. So when RONIN, of all firms, imploded in the great volatility spike of March of last year, it took a lot of people in the space by surprise. You did a pretty fascinating case study of how all that went down. I know it's hard to encapsulate it all, but give our audience a quick synopsis, a breakdown, if you will, Paul, of how all that went down.
Well, so I happen to be lucky. I have tuned my alert system to detect when new pieces of information come out. Whether it be regulatory or certain stories about certain firms. And Since in lockdown, I pretty much work 24/7 and I'm sitting in front of my desk. It's usually on a Friday afternoon or a Friday night that you learn. I think in the case of Ronin, maybe it was a Thursday night, but information was coming out from ABN AMRO clearing going into Friday. And I hadn't done any modeling of the regulatory data on Ronin yet at that time. And so I spent the weekend pulling 13F reports and focus reports, broker-dealer type regulatory filings that gets to, you rarely can see the income statement, but you see an annual view of the balance sheet. And there are segments in the balance sheet that give you an idea of what kind of trading was going on based on the nature of their holdings and their asset mix. So I spent the weekend creating, I'd say it's a mini case study. I published it on our blog. I didn't, because I knew the story had to go out fast. Our big case studies, like a Jane Street case study, which has 140 exhibits, and is, 26,000 words over 100-page report. That is our, super deep type of case study that I published exclusively to premium subscribers, and those go out. Those are monsters. They take a while to build. Just as a comparison, the Ronin I did over a weekend and probably published on a Sunday at some point. Created a bunch of these charts that looked at the type of holdings that they had and the size of their balance sheet, to give a sense of, because nobody has that other than the clearing firm. Nobody independent like myself, nobody's really going to go and publish something like that. So that story attracted a ton of attention because A, nobody had heard because the details were still coming out on a Friday night. And B, nobody really, all you really know about firms like a Ronin, since they're private, is their mythology and the anecdotal evidence that's accumulated because people leave or people are in, close proximity to some things that they do, that you get little snippets. But what I have done is go in and model certain filings to expand that understanding. We still, we're still hungry to learn more. It's sort of like the more the more you think the less you really know. And there's tons of details that I certainly hunger to understand. But in the absence of no information or, little clear information and only snippets of anecdotal information and mythology, what I do tends to be like this bright spotlight that brings some clarity where there really is none. And that, was the Ronin story from early 2020 is a quintessential example of something that happens from time to time when ALPHACUTION is sitting at the right place at the right time.
So really quickly then, was it as simple as caught holding the bag on some short SPX puts or maybe short mixed calls, or from your research, was it a little bit more nuanced than that, Paul?
Well, I think what ultimately escaped, I always, I knew John Stafford, the dad, and we were members at the LaSalle Club way back when and would run into him from time to time and have friends that have worked there or still work there. So, growing up in Chicago option world for the past 30 years, you know a lot of these people, and I certainly knew the mythology. And I always considered the Staffords and Ronin to be among the pinnacle of risk managers. I think that's what really allowed them to grow and thrive and be a legendary prop firm for so long. What stung them is that the problem arose from an investment that they had in an outside group called Par Plus Partners. And so because of the joint back office, Ronin was on the hook for some of Par Plus's risk. And so when Par Plus, which is a yield enhancement strategy selling wings essentially, and you had such a dramatic spike in vol, they got stung and Ronin went down with them. It was pretty much as simple as that.
The old shared books that comes back to bite you at the end of the day. That kind of highlights another trend we've talked about on our network for quite some time, Paul, which is the fact that, the way I got into this business, a lot of people got into this business, the market making route. There are far fewer of those firms around today than there were, let's say, a few decades ago, certainly in the go-go boom of the 90s. And it seemed like everybody wanted to trade options on the floor of the SIBO. So we've been exploring different ways over the years and talking to a lot of our different guests about what we can do to potentially reverse that trend and potentially incentivize some new firms to come into the market making space. I'm curious, someone like you who spends your days, like you said, your Friday nights out there reading the circulars and studying the macro structure of the market. What do you think we can do as an industry, as a market, to try to incentivize more firms? Or perhaps surprisingly and ironically, did we maybe already have that last year with 2020? Was the explosion of volume, maybe was that the advertisement that we needed to get people excited about these markets again?
Potentially, but I think it's the risk is that it's a fool's errand for new entrants. The bar is getting higher as we tend to have this intuition that it's harder and harder and harder to start a new prop firm in listed markets when so much technology is being deployed by the leading and subset of dominant players. I mean, they love new players at the poker table, but I don't think that the probability of success and being able to be in the game for a long time and scale new businesses, I think that's becoming harder and harder and harder. And that's the challenge. Certainly there's a lot of enthusiasm, but one of the themes of ALPHACUTION's research is you can read in various places is the overarching theme is understanding the impacts of technology in capital markets. And one of the things that we see from other industries, take the likes of Amazon, for instance, or Google, or the FANGs in general, and we see it in other places. Technology, when it becomes industrialized, creates winner-take-all dynamics in the markets where it's deployed. So it allows you to scale beyond where you could scale before, because you're not just adding bodies to the equation, you're just expanding technology, and technology has a whole different capacity dynamic than putting a team of human capital together. So that when you see the events of 2020 and the unprecedented volume, particularly in options, yes, that makes prop firms stronger, but it makes a short list of prop firms stronger. It doesn't necessarily mean that there's this nice, slick on-ramp of new prop firms. So we have a bit of a balancing act there. Certainly the folks that are already successful, have track records, have systems and platforms, and are able to compete for ever fleeting spreads and pricing inefficiencies between and among markets and fragmented market centers, liquidity venues, and products, those firms have gotten stronger. But I don't think that translates into a new golden age or a second golden age for young, small, new prop firms to come in and be able to scale. I think there are some examples of newer firms like Simplex and now XTX. So I'd say those two are the youngest, newest, and most successful of all those that have attempted, at least in the U.S. You see, cryptocurrencies and digital assets are a little bit different because that's a little bit more of a green pasture. So there are opportunities for trading in digital assets for new prop firms to come into that space. And we see that globally. That's not just a U.S. phenomenon. That's, you see it in Hong Kong and Singapore and Sydney and elsewhere in the U.K. But as for U.S. listed markets, I think it's a bit of it's a bit of an illusion to think that all this volume is going to leak into opportunities for new young players to come and trade some tried and true strategies, scalping and being able to use systems to discover and harvest inefficiencies between and among all the products and fragmented liquidity. To put a exclamation point on all that, I do see concentration risks. I do fear that the dominant players are too dominant. When you have the top two players in options capturing more than 50% of the volume or right around 50% of the volume, that's an awful lot of concentration. Now, those firms are the best of the best, but we don't know what we don't know. And I think that to level the playing field means not so much to deal with payment for order flow, but maybe to deal with this concentration risk we have amongst the dominant players. And that's a regulatory solution. And I'm dubious at best to expect that regulators can walk and chew gum for long enough to figure out how to fix that kind of concentration risk.
Yes, the old school cynicism of someone who's been around the markets for a long time, particularly when it comes to all things regulation. Unfortunately, what you said, Paul, kind of echoes what most of our other guests have said as well, that, we had Thomas Petterfee and Blair Hall on the network asked them that exact same question. They both kind of laughed at me and said, yeah, there's the startup costs and the tech costs are just too prohibitive. And those are obviously two storied names in the early days of the market making space. So hopefully, perhaps, maybe this crypto resurgence is the resurgence we all need, Paul, to get some more liquidity providers into the game. But unfortunately, that music, Paul, means we've come to the end of our journey here on the Options Insider Radio program. It's been a fascinating one. We talked PFOF, we talked Robinhood, we talked the demise of Ronin, we talked macro and micro options market structure. But before we go, Paul, we like to leave our audience wanting more. So if you have any hints, any teases of some interesting research you guys are working on over there at ALPHACUTION, now is the time, sir. The floor is yours.
Well, Mark, before I say that, it's been a lot of fun. I've enjoyed the conversation and a little bit of the walk down memory lane. And if you're talking to guys like Petterfee and Hull, then you're definitely getting some of the best viewpoints that you could have. I'd say the best tease I've got is I've ground as much PFOF data as I can find. I'm working on a big case study that will be published hopefully by the end of the quarter, Q1 here, by the end of the month. That's going to be a tall order. There's a lot of charts and a lot of numbers that have been ground into consumable bits. But we'll have more coming at alphacution.com, both in terms of small tidbits that are easily consumable, all the way to those who are have serious economic interests in the big case studies. And from there, I want to launch into some case study work on the short list of option market makers and key players in that space. I'm eager to get to that. I just thought it was too important to stop and understand the payment for order flow and options before we went and did that. So that's what's coming up in the next couple of quarters for ALPHACUTION, and hopefully members of your audience that are not familiar with us will come and check out what we're doing here and give it a read.
Well, Paul, this has been a fascinating conversation. What you guys doing over there at ALPHACUTION, certainly unique in the space. I don't know anyone else who's doing these deep dives and recreating the books, if you will, these various prop firms. So if you are interested, check them out at ALPHACUTION. You can also give them a follow on the old Twitters at ALPHACUTION, ALPHA, and then Cution, CUTION, all one word there. And Paul, like I said, this has been fascinating stuff, and we'll look forward to seeing how all your new research, how it all unfolds in the marketplace in the coming months, sir.
Thanks, Mark. It's been fun. Thanks, buddy.
And thanks to all of you out there for downloading, streaming, and listening to us today. Remember, we do a lot more than just interviews here on the network. Of course, coming up tomorrow, we have Education Wednesday, Options Bootcamp, Options Playbook Radio, two shows I know many of you enjoy these days. Thursday, back with episode 2 of the Option Block, and TWIFO, This Week in Futures Options. Friday, dive deep into volatility with Volatility Views. And we're back again on Monday with the Option Block and the Crypto Rundown all the way through to next Tuesday, another Interview Tuesday, and another episode of Options Insider Radio.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.